if you can factor in a 25% flex rate into your plan, so that would be if you spend $60,000 per year, if you have wiggle room in your situation of $15,000 per year, then that actually leads to a 100% success rate, even if you're 100% invested in stocks, and even for if you're retired for 100 years. So like the highest risk, longest term scenario, it still gets you to 100% success rate under all of the worst conditions in history based on just 25% flexibility using the 4% rule.
The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you, and if in doubt, speak to a licensed financial advisor.
Hey guys, welcome back to another episode of the Aussie Fire podcast. So everybody listening to this podcast right now is probably heard of the 4% rule when it comes to retiring early. So today in this episode, we're going to be discussing whether it still stacks up as a rule of thumb to go by when you're planning your retirement and your financial independence. So in particular, we'll look at where it came from, why people seem to be getting worried about it, because I've seen some stories about it, why it may not be sustainable anymore, things like that. And we'll look at the assumptions behind that and how we think it works with real life scenarios, especially in the context of Australia and the financial independence community specifically. So looking forward to getting stuck into today's episode, mate. Are you ready?
Yeah, for sure. I think it's a topic that people often don't really think about very early on because they're just beginning their journey. So I'm really keen to kind of unpack some of these, like what does it look like towards the end where you're really starting to, get to the benefits of FIRE for sure. So let's do it.
All right, so I suppose we should just start at the very baseline story, which is what the 4% rule actually is. So for those who aren't familiar, here's a very brief rundown on where it actually came from. So there was what's now essentially a famous study at Trinity University in the US. So researchers looked at stock market data over more than 100 years, possibly 150 years or longer, however long we've got it for. And they essentially wanted to stress test retirement scenarios looking at different types of stock portfolios, assuming an index-based portfolio essentially, to figure out how sustainable it would be to live off these types of portfolios for retirement, which in this case was a time frame of 30 years. And so what they actually found was, through this stress testing, that a portfolio of stocks, so they measured stock and bond portfolios specifically, and what they actually found was if the portfolio was somewhere between 75 and 100% stocks, it led to a success rate, or what they were called, of between 95 and 98% success, I believe, where the portfolio didn't run out after 30 years. So hopefully that makes sense. And the assumption behind that is you start with a portfolio, let's say it was $1 million, and based on 4%, you would withdraw or spend $40,000 from that portfolio in the first year. And then after that, you then increase your spending and what you're withdrawing from the portfolio with inflation each year for the foreseeable future, essentially. And then after 30 years, there was an overwhelmingly almost guaranteed chance that the portfolio would still be alive. Essentially, it wouldn't be at zero after 30 years based on those stock allocations.
What's the drama then?
So the drama, well, not the drama, but I suppose another thing that goes into those calculations is that includes like all of the worst possible scenarios. So like a decade here or a decade there of no returns where there's market crashes and then there's big inflation spikes or there's wars and things like that. So it included all of that, but I suppose the big pushback, or one of them at least, is regarding the FIRE community, where they're like, well, you don't have a 30-year retirement time frame. You may have a 50-year retirement time frame, or maybe even longer. If you retire at 35 or something like that, you might have 60 years. So then how the hell is that going to work? Because from my understanding, when you stretch the data out a bit longer, 4% becomes a little bit less sustainable, to the point where it would seem more prudent to go with like 3.5% or maybe a bit less than that again. So then people are like, well, it's not sustainable for FIRE based on this assumption and this time frame in particular. So that's where some of the pushback comes from. And some of the other pushback comes from the idea that we've had too strong of returns in the last decade or decade and a half. And so then it's not sustainable to assume average long-term returns from here because we're at a high level at the starting point. Because obviously if you start and you retire now and the market is at some sort of a valuation high and then we have a nasty drawdown, then you start depleting your portfolio more quickly, which they call sequence of return risks, because the bad returns are up front at the start of your retirement. So then that increases the risk of the portfolio depleting quicker than it otherwise would in a more sort of average scenario.
Do you think there's more tension out there that 4% is not enough or that 4% is too much? If you just think about your community and your listeners and in your strong money world, Dave.
That's a really good question. I would say in my particular community, people are more likely to believe that 4% is enough because of the things that I've been speaking about over the years, I would say, because I've written about this a couple of times. And so I don't agree with the pushback to 4% being too much, because I think it misses a whole lot of factors, especially FIRE community specifically, factors that apply to them that don't necessarily apply to older or traditional retirees. So, but when you retire at a younger age, you're way more likely and able to work for the, maybe not immediately, but sometime between, for the rest of your life, right? If you retire at 35, it's very, very unlikely that you never earn any money ever again from another source. And that's one of the assumptions behind the 4% rule. So I don't really see that that's ultra realistic for someone who's going to be retiring earlier than traditional retirement age, because just by sheer nature of having tons of time and tons of energy and being in that age bracket, you're super likely to earn something doing something productive. So then straight away, the 4% rule actually becomes quite conservative. And then as most of us in this sort of community are used to, living relatively simple lifestyles within our means most of the time, that means we're almost adaptable by nature, right? We've learnt to spend less so that we could save more and so we could invest. So if you then extrapolate that to a retirement scenario, then if you're willing to optimize your expenses, if the market was in a downturn, and spend less for a while, then that dramatically increases the chances or the longevity of your portfolio over decades. So lots of different things that you can do under that sort of scenario, where the 4% rule assumes worst case, assumes the worst possible returns, absolutely no flexibility, absolutely no income, no optimization of any kind, no sort of cash buffer to avoid selling during bad times and things like that. It assumes no pension, obviously, which the pension's fairly significant in terms of a source of income. If one was to really need it, then that would eventually kick in, and nothing else of the sort, like inheritances or super fund if you haven't included that, and all the rest of it. So I think in a lot of cases it is fairly conservative, but I would say that broadly the finance community in general would say that the 4% rule is perhaps too optimistic, but I think they're overlooking quite a few things.
I feel like for me, Dave, it's interesting how you talk about, a lot of these numbers are for like the 30-year plan, whereas for people who are trying to not work earlier in life, say stop working when they're 40, it's more like a 50-year plan. The two big things for me, and one of them you covered, is like when you are younger, your capacity to change circumstances and generate some income is a lot higher. So, if you're 40, pretty simple example, and you get to 50 and you start to notice your portfolio is dwindling faster than you planned, it's pretty easy for you to get a little bit of work. You're able-bodied, all these kinds of things. Like maybe you don't want to do it, but you can do it. That's very different when you're 78. It's a very different kind of situation just in terms of your circumstances or health potentially. I think the other part, and we talked about this in a previous episode, but when I'm in my 30s, so I haven't been there being older, but I imagine, when, let's say you're 60, you've got your, retirement portfolio now, you're going to proportionally have more of that portfolio in lower risk assets when you're 60, because you're going to be consuming them a higher proportion of those investments you have in a shorter time frame, in theory. Whereas like if you have a portfolio when you're 40, say, and you're trying to live off that for 50 years, you're going to have probably a greater capacity to be invested in higher return, longer term stuff, because like the number of years that are in front of you that are more than 7 years away is higher. So I imagine as well, like some of these studies wouldn't take into account the fact that someone who's 40 will just inherently, and going to die at 85, will inherently have a riskier portfolio proportionally if they're, using the same logic to approach it than someone who's 60. And that'll naturally improve returns over time.
Well, it's going to depend on your portfolio allocation over time, like the starting allocation. And it doesn't assume, I don't believe it assumes any sort of dynamic allocation over time. I think it goes for like a static. So I would bet that most people in this community are going for a more aggressive portfolio. And I would say that they will probably stay mostly aggressive over the decades, even in retirement. And I would put that at, in the region of 90% or more invested in the stock market, assuming, they're not doing rental property and all the rest of it. So what happens is you're essentially taking a bigger long-term bet, which is more likely to pay off over a 30, 40, 50, 60-year time frame, which is actually ironically going to give you a greater chance to produce enough income for you to live a very high quality of life later on. So there's that to consider as well, because you could take a more conservative approach, but then sometimes that actually increases the risk that you run out of money. So I think that's something that maybe is underappreciated or people don't really think about too much.
Yeah, I mean, I think I said it. I think a lot of I'll just check it now, but it's like when I look at VAS, just a simple recommended holding time, they say 7 or more years. So I think it's a very simple thing. Even if you're a conservative person, even if you're someone who's really scared of stuff, and you were 40 years old and you thought you were going to have 50 years left to live, which is, roughly 7 chunks of 7 years, you'd in theory keep 6 out of 7 of those chunks in high return stuff and keep 1 out of 7 of those chunks in something really conservative, like fixed interest or whatever. Because, let's say you're someone who's just really anxious about that because, you've got your portfolio that's got 7+ years to recover from any downturns, et cetera. And I think that can be a really healthy way to look at it, because I feel like there's this, at least people I talk to, they have this image in their head that's very kind of one-dimensional when they think about their portfolio, and early retirement is like, it's all just going to be vast. And then like the stock market goes down. Oh my God, that means every dollar I spend is more punishing than it was like a week ago and all this kind of stuff. But if you are really scared, you can just carve out a chunk of money. It's not hard to sell out, a seventh of it. I mean, you wouldn't, that's a very heavy-handed way to do it, but you get the point. It's like you sell out a chunk every year, you put it in something safe, and then you don't have to worry about what's happening in the market and how that's affecting your life for that year, because you've really kind of locked it into a savings account or something like that.
Yeah, no, that's a good way to put it. I think we've talked about in a previous episode about what to do when the market crashes, and I think we discussed that for retirees as well as accumulators, so people can go back and listen to that if they're interested. But what you're saying there points out something that's very important too, is the psychological aspect of all of this, because it's all well and good to say, very high stock allocations and more aggressive portfolios tend to perform the best over the very long run, but that doesn't really help you if you're going to be very nervous living off that portfolio, because if you cut ties with your job, obviously you're super reliant on that portfolio performing to a certain degree, right? So then that can become quite challenging from a stress point of view in itself, and makes you feel very differently about your retirement and your life and all of your plans going forward, because one nasty year in the markets is going to radically change your perception on how comfortable your situation actually is. So you definitely have to consider, if you haven't been through any long drawdowns at this point, which I would consider something like at least 30%, because 20% isn't really that much. Because if you're going to be living off a portfolio for many, many decades, you are going to see 30% falls, you're going to see 40% falls, you maybe even see a couple of 50% falls. So it's one thing to know that in theory, but then to live through it in practice is another thing. So I myself have not been through a 50% fall. I've been through an almost 40% fall during COVID. And while that was a little bit unnerving, I guess. It wasn't really a big deal. So yeah, the psychological aspect is important, because if you're someone who is, as best you can imagine, if you think you are going to find that extremely unsettling, then you're going to want to keep more of your money in sort of an offset account or bonds or something like that, as Hayden is suggesting. So then you can not only feel better about your situation when those things happen, because that will dilute the effect of how much the market fall is affecting your wealth. So not only that, but it will also have a practical element too, where you can use those funds instead of selling down your portfolio to fund your lifestyle. And that's going to make you feel a whole lot better. So I usually recommend to people, if they're going to be leaving work, to have at least 1 year's worth of spending in a bank account, like an offset or savings account, because that's going to just, like you said, Hayden, take your mind off it completely for the entire year, because you know that the entire year's expenses are already covered. So you don't really have to kind of nervously watch the market every single day during that period of time, which is going to be super important.
And this also ties into, like, you've been asking for a while, Dave, for me to release the feature in Pearler Automate, which is like automatically selling down a portfolio. And if I'm understanding this right, it's not so much that like you would approach selling out your portfolio every month. Let's say that was your plan. You had high growth stuff, so you were selling it out, so you weren't really getting income things. You wouldn't really sell it out every month to then give yourself the month of spending. It's more like you probably have like a year's worth of spending in front of you as like a buffer, I imagine. And then you would, or 6 months or something. But then like obviously every month you're spending into that, you'd want to be trying to sell another like chunk ahead and basically be like dollar costing on the way out. Is that a fair summary of how you might approach that, or not really?
Yeah, it is actually. So I would probably, before I left work, I would probably decide on a buffer or a level of money where I wasn't taking risk with that money. So that would be cash or bonds or something. And so I would decide on a level I'm comfortable with, whether it was a fixed dollar amount, like say $50,000 or $100,000, or a percentage of my portfolio, say 5% or 8% or 10% or something. Doesn't really matter. It's going to depend on the person. And so how I would do it is I would have that chunk of money in the bank account, what I was happy with, and then I would have this auto sell feature running in the background to then kind of top up my bank account as I was spending whatever amount per month. You know, if it was $4,000 a month, something like that, right? But I'm not sure how you were planning to create it, but obviously when you have a portfolio, maybe a mix of Aussie index funds and international index funds, you're going to be receiving some dividends from those funds along the way, right? So you don't actually want to sell 4% per year, because you're already probably going to be receiving, like, I'm going to say 3% maybe from the portfolio in income, 2 or 3%, depending on the breakdown of it. So you only want to sell small parts of the portfolio. So that would just kind of help top up your spending or your cash flow from the portfolio without you having to then log in and sell those shares.
So if I built that feature, you'd kind of want it to look at distribution returns, maybe make a quick tax estimate, and then try and find the gap, like fill in the gap. Is that the gist of it? Like say you wanted, $5,000 a month in spending. Let's say you get distributions and dividends of $3,000 a month. You'd obviously want to not sell $5,000 that month. You'd want to sell kind of 2, or if you were getting more specific, 2 and change to account for the eventual tax bill. Is that do you think that would be a significantly more useful feature in a platform than just selling out a fixed amount every month?
Yeah, well, you could do it either way, because you could have the person's portfolio, because by the time you reach early retirement, right, you're already very familiar with your portfolio and how much it's basically spitting out each year in income. So you're like,
you
okay, well, that's only
what you want to sell down by that point.
You would know roughly, right? You would know. If it's $1 million portfolio and you're getting $25,000 a year in dividends or something, you're like, okay, well, I can basically top this up to the tune of like $15,000 a year. So let me set up an automate feature to sell like basically $1,200 a month of my US shares or something like that to top up my bank account and to give me that 4% from the portfolio, if that makes sense.
Yeah, that makes sense.
All right, so if we just round off what I was discussing earlier, I would say for traditional retirees, I think the 4% rule still makes sense as a valid kind of benchmark to work from, because their time frame is going to be 30-ish years, 35 years, maybe 40 years. I do think that still makes sense. And then obviously they've got a pretty solid income stream as a pension which is going to be a backup, which is fairly valuable in itself. Now, it might not be ideal and you might not want to plan for it, but the fact is that it is there if you absolutely need it. And then for normal, the FIRE community, I do think the 4% rule is still fine because, like I said, you can hold some cash, you can spend less money, you can earn some income, and you probably will whether you plan to or not. And then you may or may not have factored in your super, and then you also have pension as a backup. So all of those things make a significant difference. And when I started writing about investing and financial independence, I got a lot of questions and pushback around the idea that it's sustainable to live off a portfolio for a long period of time because of the fact that the share market, crashes and does all these sorts of crazy things from time to time. And I knew intuitively that doing these things would make a massive difference, but I couldn't actually pinpoint any sort of numbers on what level of impact it could make because I wasn't sure how to calculate it myself because you need to back test all these sorts of scenarios and whatever. And I had no idea how to do that using, whatever data I could get my hands on. But I found a calculator that I could do that from, and I could build in this flexibility component that I'm talking about and that I had preached over time on the blog before I actually found some way to kind of measure it and measure the impact of it. So I've mentioned this calculator on the podcast before, and it's called the Post-FIRE calculator, and it's by a website called Engaging Data. And so it lets you put in this little input where it's basically like I like to call it like a flexibility meter where you can adjust how much you're taking from the portfolio, and you can say, okay, basically when the portfolio goes down 20%, I will then add, $10,000 worth of flexibility or $30,000 worth of flexibility, basically, based on percentages, right? So what I found was I played around with this calculator for ages because I found it fascinating. So what I found was, if you'll just humor me for a moment, mate, and let me share my findings, because it's very exciting. It's very exciting. So what I found was, if you can factor in a 25% flex rate, which I like to call it flex rate, into your plan. So that would be if you spend $60,000 per year. If you have wiggle room in your situation of $15,000 per year, then that actually leads to a 100% success rate. Even if you're 100% invested in stocks, and even if you're retired for 100 years. So like the highest risk, longest term scenario, it still gets you to 100% success rate under all of the worst conditions in history based on just 25% flexibility using the 4% rule. But it gets a little bit better than that, because if you can manage a 40% flex rate, which would be say $24,000 if you're spending 60 grand, or $40,000 if you're spending 100 grand, then you can actually get the same level of success, but using a 5% withdrawal rate. That actually makes it perfectly sustainable. And then to go one further and be a little bit crazy with it, if you have a 55% flex rate, if you can manage that, which would be 33 grand a year if you spend $60,000, or 55 grand a year if you spend $100,000, then you can actually withdraw 6% and still get to a 100% success rate based on that level of flexibility. And you might think, well, that's actually a lot of money and that's actually a lot of flexibility I need to build in. But when you think about it, it's not that difficult to do, because yes, you may struggle to reduce certain costs in your life and whatever, and there might not be a massive amount of wiggle room, but you could probably manage like $5,000 to $10,000 quite comfortably of reduced spending if you really, really needed to. And then you can work on the income side, right? So you could work like very minimal part-time work. You could probably make, $20,000, $30,000 a year, only very temporarily if the market was to basically shit itself for like a year or two in a less than ideal scenario, especially earlier on in your retirement. If you can manage to do these things, then that's going to put you at a basically like a 30 to 50% flexibility rate, right? Compared to your situation. So you can obviously tailor this to your specific circumstances, but it makes a gigantic difference over time, to the point where 4% looks extremely conservative and then 5% is still conservative. So if you can manage these things, you can safely ignore the people who are going to say that 4% is, not sustainable based on X, Y, Z. And so I think that the outlook is far rosier for people who have some sort of adaptability in their situation than the average person and than what the studies would assume.
I think they're really exciting numbers. And I think that, I mean, the core theme of, I think what you're getting at here is like the scary part isn't, is it 4%, 3%, 5%, 6%? The scary part is how much control do you or do you not have over your circumstances? That's really what's going to affect you more than, or do you, as you would describe it, the degree of flex. Because the degree of flex will save you from a number that's too aggressive, essentially. So I think that's a great thing. Like a lot of people like to sit around and say, 4%, 5%, but they should really be like, what flex do I have in my FI, passive income number? And that'll help me dictate exactly what I can or can't do with this to find the security that I'm looking for.
The hilarious part of all this is the people who are painting these doomsday scenarios, or not necessarily doomsday, but trying to be overly conservative and look at just pure stock market data, maybe some valuations of markets currently, when they're trying to consider, what's a reasonable withdrawal rate to factor in and to rely on. What they're not considering is that if you were to use 4% and it turned out to be the worst period in history for stock market returns and your portfolio starts depleting, they're assuming that you're basically just going to watch your portfolio shrink and shrink and shrink and shrink and shrink and go to zero, and you do absolutely nothing different. You just watch it. You just watch it and you keep spending exactly the same amount. You keep deciding, nope, definitely not going to do any work whatsoever. I'm just going to watch my portfolio go to zero. So they assume like these kind of silly assumptions, I would say. And it's one thing to say, I want to factor in a scenario where I don't have to work no matter what. Then yes, then it makes sense to be like, okay, well, I'm going to need a bit more cushion. I'm going to need to be maybe more flexible on spending, or I'm going to work on a lower withdrawal rate. That makes sense. But to suggest that there's almost no options, right? That you have no control and you're just completely reliant on stock market returns in the future, which are essentially unknowable, right? We're just basing on, reasonable expectations and long-term history. To suggest that you're just going to sit there and be like this helpless little duck and you have no options and no kind of power in the situation is just silly. So I struggled to get behind any kind of assumptions and case studies and forecasts that assume absolutely no behavioral change and absolutely no wiggle room on the part of the investor. That just doesn't make sense to me, especially for the FIRE community in particular. That just doesn't really... Does that make sense to you, Hayden, or do you think that that's a bit silly to make all of those assumptions?
I definitely think it's silly. I mean, you can't find security over a half a century period.
Like people are looking for the illusion of certainty that will never exist.
Yeah, exactly. And it's like, that's hard because I'm sure that there's a massive correlation with the people who are looking for FIRE or looking for, financial independence or looking for early financial independence. I'm sure there's a massive correlation where these people are the people who tend to disproportionately seek financial security and safety and predictability more than a typical person. So it's probably to some degree going to be difficult for some people too to be like, hey, we don't know how this is going to go. Costs could go up, electricity could go up, like lots of kinds of things should happen. I probably think of this more as like, I know sometimes we say things like, oh, well, you can always just go get another job. We've talked about this in the last few episodes on and off. That's obviously easy to say and hard to do once you've tasted the sweet nectar of not. So I think, the flex part should probably always come into the spending element in some way, shape or form. A lot of people I see that get into the FIRE movement, or if they want to FIRE, they want to travel. Or, they want to do this. And it's like, it's actually really easy to just not travel for 3 years. And, that's where you should take some comfort and know that you've got a very, long, illustrious life left, I guess.
I see where you're going there. I would agree with that because personally, I would prefer to reduce spending than to try and make income in a retirement scenario. That would just be my go-to option because I'd prioritize freedom over lifestyle essentially. But I do know that there are people out there, even in the FIRE community, who would be, maybe they're a little bit older, but who would be way more likely to lean towards, well, if something really happens, I am more than happy to do a little bit of part-time work, even 1 day a week, but I don't want my lifestyle to be affected, because this is essentially like my freedom time. I want it to be what I've planned for. I've worked for, 10, 15, maybe 20 years to get to this point. I want to keep my travel. I want to keep my, going out to restaurants. I want to keep this and that, keep spending on my kids, whatever. So I don't want that part to be affected. So to compensate for that, I am willing to do some work if I need to, if the portfolio really kind of situation calls for it. So I think it's going to be situation and personality dependent on which kind of one of these flexibility strands you want to pull at to kind of compensate for a terrible market situation.
I think that makes a lot of sense.
I suppose the other aspect for the people that are a bit more conservative is that you can work on an assumption of, okay, let's work on 3.5% instead of 4%, because I'm not really comfortable with that. I'm just not much of a risk taker. I would rather have more than I need just in case. And I would rather minimize my need to be flexible. I'd rather not do that. So let me work on a lower baseline assumption. I don't have any problem with that at all. But the only thing I would say as a counter to that is it can be very, very tricky to then switch from like, okay, I'm going to work until I hit 3.5% withdrawal rate, right? And then you get there and then you're probably going to second guess yourself again, be like, oh, maybe I'll go for 3.25 or 3%. That would be even more conservative. So it becomes this one more year syndrome, right? It's basically exactly the same thing where your conservatism is causing you to just stay at work longer than you need to, out of fear and out of comfort and out of not wanting to disrupt the status quo. So that's my only concern with those kinds of people, is if they're very, very conservative and cautious by nature, they're more likely to come up with an extra reason even after they hit their new goal of why they should delay it a little bit longer, because then they'll have even more security and even more buffer. So I just see that as a potential trap in this community.
That makes sense. It's kind of ironic sometimes when you think about the fact that being conservative could be the very reason that something happens that made you want to be conservative in the first place.
What do you mean by that?
Oh, let's say you're conservative and therefore you pick like a less aggressive portfolio, which means your portfolio doesn't grow, which means you run out of money and the 4% rule's not enough.
That's an interesting possibility. Yeah.
It's kind of tragic in a weird way. I mean, I talk about this a lot as like, that was one of the things that used to upset me about the world before I started Perla in general, was like the workers of the economy, the backbone of the economy, they seem to really need money more than the people with all the capital. So they were going to park all of their money in term deposits and not investments, which self-perpetuated the cycle of them being, there's a real tragedy to that to some extent.
I think that makes sense, mate. The other aspect that I did want to touch on is when you're speaking about the psychology of it, as we are, it also reminds me of, the tendency of people to prefer income-related investments, even myself included, to be honest, where you're living on dividend income or rental income or interest income, where you're not having to sell any assets whatsoever. And so that's the reason that people tend to like that style of investing, because for certain that even if your portfolio doesn't shoot the lights out, it doesn't give you the highest income whatsoever, you don't get the best returns, there's a certainty that comes with knowing that the portfolio is never going to hit zero because you're never selling anything. So I think that's where that aspect comes in.
I get that. I think about that a lot too. Some days I have these moments where I'm like, I'm really getting sick of IVV and I just want to own a whole bunch of dividend paying stuff. So I don't have to sit around and wonder what's going to go on with Meta or Amazon. And I can just be like, yeah, Combank's probably just going to keep charging people lots of money and keep paying out shareholders.
Oh, you might be having something that we had a listener query us about recently, which we'll probably do in a future episode, which they were concerned about being overexposed to tech. So maybe you're in the same boat. So that'll be an interesting conversation to unpack in a future episode.
Yeah, for sure.
And so because of that dividends and rent type scenario, people might be wondering, well, why don't you just live on like a high yield portfolio where you don't have to sell? And although that can work and that can be a potential solution to the idea of selling down your portfolio and having that risk of asset depletion, there can be problems with the high yield approach as well, which we covered in, I think it was episode 51, where we discussed growth versus income. We touched on like the psychology of it and the other aspects of, returns and diversification. So go and listen to that if you would like a bit more of a deep dive into the income versus capital growth kind of conversation. But if we just bring it back full circle, mate, to how we think of the 4% rule, I would like to know if you were retiring right now, based on your current level of knowledge and assuming you had enough to do it, would you be comfortable using the 4% rule right now, or would you tweak it in some way?
That's a great question, because I think a lot of this stuff's very academic, and I think I would look at it and think 5 or 6 would be fine to retire on, but I don't need to retire when I hit that number. I need to retire when I hit 5 or 6, and then also just get sick of working, because if I kind of hit that point and I'm like, I'm so ready for this to be done, then I'd probably just try and wrap it up, right? Whereas if I'm at 5 or 6 and then work's going fine, I'm feeling young, maybe I'm part-time already, then I'd probably just do that till I'm sick of it, till I wake up one day and just think I'm over it, because all that does is just buffers the situation a little bit.
So you're basically saying you're more comfortable, or you're very comfortable with the sort of higher risk approach where you're forced to be flexible if the market was to shit its pants. You prefer that over a more certain scenario where you're taking, a less risky approach of living on less of the portfolio each year and not having to be flexible?
Yeah. But I mean, I think it makes sense. I mean, I lived off $17,000 a year in 2020. Like, it's not, it would be so problematic of me to some extent to sit down and think, wow, I can't ever endure any kind of temporary hardship again. There's going to be another dozen things that go wrong in life later on that aren't to do with money. It's going to be health, like money will just be another thing to sort out. So the idea of dragging myself through the mud just to hit a different type of number that's based on a whole bunch of assumptions would just feel somewhat immature, I guess, for me in my head. But I don't denounce anyone that does it, because different people have different risk tolerances with stuff, and it changes over time. So I still think it comes back to what you said. Like, I think it's about the flex element. Like, I think 6 is fine if you have a huge amount of flex, and you should get to like a 6% withdrawal as your like aim. Start there. And then be like, okay, I'm at 6%. What did Dave say? Dave said, you need about 50% flex. All right, do I have 50% flex? Not really. What do I have? About 40% flex. All right, I need to keep working till 5% works. And then that's kind of the point that makes more sense, rather than just picking a number in isolation. I guess the summary of it all is, it's not possible to have an opinion on that, in my opinion, unless you actually understand your flexibility.
Yeah, I think that's a good way to put it. If someone's listening to this and they have absolutely no interest and no desire for that flexibility in retirement, then that's fine. But you need to work that into your situation. So you might need to work longer to have a bigger cushion. You might need to build in a scenario where you're living on less than 4% if you want to be very, very risk averse and to plan for worst possible outcomes. So I don't think that there's anything wrong with that. Just be mindful of the sort of one more year syndrome that might kick in. But if you need that bigger cushion psychologically to pull the pin, then I think that's fine. Just to piggyback on your scenario, Hayden, if I was retiring today, again, I would be perfectly comfortable with 4% or 5%, just because I know how much I have an appetite for flexibility, rather than having to work longer to avoid that flexibility. That seems like that trade-off just seems heavily skewed more towards freedom sooner is better than freedom later, but more cushion. I'd rather have the freedom sooner and be willing to adapt as situations and circumstances change. I think that makes more sense to me, and I'd definitely do that. I'd be happy to do that.
I think that's a good point. And I think too, it also paints an idea that, if you're at 5% and you're not sure if you want to get to 4%, you could work another year or two, or you could just live off 5%. And if it starts to go south, work a year or two anyway. But once you work that year or two now, you can't really get that time back. And you're basically, sometimes you are in a situation where you're trading a year or two now that you're 100% going to lose to work to reduce the possibility that you have to spend time working later, which is, in certain scenarios, I don't want to be too broad brush with it because it's an extremely personal thing, but in some scenarios, you can kind of see how that wouldn't necessarily be very intuitive.
Yeah, absolutely.
So I think if we just wrap up everything we've talked about in this episode as we come to an end, we basically just explored this 4% rule and asked ourselves, is this a smart, reasonable, modern, applicable thing? The main things we highlighted in it were that a lot of the commentary you see around the 4% rule is often aimed at retirement as opposed to early retirement. And that has a lot of impacts in terms of the earlier you retire, you might have a different portfolio composition. You're going to have more uncertainty in the future. You're going to have more ability and be more able to work if things change over time. We talked about how sometimes, 3.5%, 3% might be suitable for some people, 5 or 6% might be suitable for other people. But one of the main things that matters is the degree to which you have flexibility, because the more flexibility you have, the more you can assume out of your portfolio, because the better you can adapt to things that change, how market changes, how your circumstances changes. Can you cancel that trip? Can you cut down your weekly spending? Can you, move house? Can you sell some assets that you have that you maybe don't need and look at buying them later? Can you get temporary help from your family whilst you're dealing with a downturn? All kinds of things. And we also unpacked a few extra little tips along the way and discussions about why, people might prefer income over growth and a few other things like that. But hopefully you found this episode really interesting. I certainly think it's interesting. I think it's a very aspirational episode. Many of our listeners, including myself, certainly love to kind of romanticize this topic because it reminds us of good problems to have in the future when we're kind of closer to, the fully fledged idea of financial independence that we want to have. If you do have any kind of thoughts on this topic, questions you want to ask, or maybe you want to share your own story and have us kind of answer any questions you have about your circumstances, you can actually follow a link in the show notes where you can submit essentially, that question or about your story if you'd like to. If you have any other general questions for us, you can reach out to us via email at hello@aussiefirepod.com, or you can reach Dave at Strong Money Australia socials or myself at Perla socials. Otherwise, it's been a pleasure having you all listen to us today. Thanks for your time, and we'll chat to you in the next episode.
See you guys. Thanks for listening.
We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to perla.com to browse our resources, calculators, and community insights. Perla is an authorized representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk, and past performance is not a reliable indicator of future investment returns.